All right, today we're cracking open the latest quarterly report from Grainger. Now, they're a massive player in the industrial supplies world. We're going to see what their numbers can tell us about not just their business, but the broader economy, and of course, what their game plan is for the future.
Because let's be real for a second. An earnings report can look like a total wall of numbers, right? But it's really not. It's actually a story. It's packed with clues about a company's strategy, the challenges they're facing, and where they're placing their bets. You just got to know how to read between the lines.
And that's exactly what we're going to do today. We're going to translate all the jargon, all the financials, into a clear story about what is really going on inside Grainger. So let's dive in.
Okay, first up, let's hit the big picture. These are the headline numbers, the ones that give you a quick snapshot of how their quarter really went.
$4.7 billion. That was Grainger's total sales for Q3. That's a really solid number, and it tells us that demand for what they sell is still going strong.
And this one's just as important, $10.21. That's their adjusted earnings per share. So yeah, they sold a ton, but they were also super profitable, turning all those sales into real earnings for their investors. Now here's where it gets really interesting. You put it all together, sales are up over 6%, earnings are up more than 3%, both great. But see that operating margin? It's down just a little bit. We're talking 40 basis points. It's a tiny dip, but it's a huge clue. It tells us that while the business is growing, their costs might be growing just a little bit faster. And that begs the question, why? So to figure that out, we've got to understand how Grainger actually works. You can think of the company as being powered by two totally different engines. On one side, you've got what they call high-touch solutions. This is their classic, traditional business-to-business model. It's built on deep customer relationships and a ton of expertise. Then, on the other side, you have the endless assortment engine. This is their fast-growing online-focused side of things, like Zoro.com and Monotaro over in Japan. So think of it as old-school expertise versus new-school digital scale. And wow, this chart just says it all, doesn't it? The traditional high-touch business grew at a respectable 3.4%. But look at the endless assortment business. It just exploded with almost 15% growth. It's crystal clear that this online, high-volume model is Grainger's growth engine right now. Okay, so let's get back to that little dip in profitability. This leads us straight into the most complicated, but honestly, the most important part of this whole report. We have to take a little dive into the labyrinth of accounting. So what's the big headache causing that pressure on their margins? Well, you might be surprised. It's not a new competitor. It's not a supply chain disaster. It's an accounting method. It's called LIFO. It's a wonky term, I know, but it stands for last in, first out. It's just a way of valuing all the stuff they have in their warehouses. And here's the key. When Grainger sells something, LIFO accounting assumes they sold the last one they bought, the newest one that just came in the door. So why on earth does this matter? Well, because we're in a time of inflation, right? Everything costs more. So that newest inventory is also the most expensive inventory. By matching every sale against these higher costs, LIFO accounting actually makes Grainger's reported profits look lower than they would if they used a different method. It's like a headwind created by their own accounting choices. And hey, don't just take my word for it. Grainger's own CFO, Dee Merriweather, said it as plainly as you can on the earnings call. She basically pointed out that if you just strip out this LIFO effect, their gross margin would have actually gone up. That's how much of a difference this one little accounting detail makes to their whole story. So while they're navigating all this complex accounting, they're also making some absolutely huge strategic decisions this quarter, signaling a major shift in where they're focused around the globe. And this one is a biggie. They are pulling out of the United Kingdom entirely. This means selling off their Cromwell business and shutting down the UK version of Zoro. It's a massive move, and it resulted in a nearly $200 million loss for the quarter. So you have to ask, why such a dramatic exit? Well, the CEO, D.G. Macpherson, didn't mince words. He linked it directly to the economic fallout from Brexit. The company basically looked at the potential for growth in the UK and decided, you know what? Our money and our energy are better spent focusing on our core markets in North America and Japan, where we're seeing much stronger growth. So with all of that in mind, you've got strong growth, these accounting headwinds, a major strategic pivot. What does the road ahead actually look like for Grainger? Well, the company tightened up its earnings forecast for the full year, which is usually a sign of confidence. But they're definitely keeping a close eye on some clear challenges, like the potential fallout from a U.S. government shutdown, having to compete with last year's hurricane-driven sales boom, and just the ongoing inflation from tariffs.
And if you look even further down the road, the CEO made it really clear that technology is at the center of their long-term strategy. They're pouring money into areas like AI, not just to make themselves more efficient, but to actually build smarter, better solutions for their customers.
Which really brings us to the final question, doesn't it? Grainger is navigating this really complex world. You've got persistent inflation putting pressure on their bottom line, while at the same time you've got amazing new tech like AI offering a path to huge growth. They've made some bold moves, like ditching the UK to focus their efforts. The big question is, can this strategy keep powering through all the headwinds and deliver for the long haul?